So you mentioned down payment assistance programs.
Right.
So I know that there's a whole lot of them out there.
There are.
But why would someone? What is beneficial about using one?
Well, as we discussed earlier, if it's going to take you a while to put together the down payment, I would say go for it, because as I said, let's start building that equity. Let's start, getting in at that price point and grow from there. But there's some cool options out there. So as an example, there's a program called Home Advantage that Washington State Housing Finance offers that's pretty aggressive in terms of what it allows program-wise, because most down payment assistance programs are going to have an income limit. Well, the Home Advantage program has an income limit, but it's $180,000 a year. A lot of down payment assistance programs require you to consider the income of every household member over 18 years old. So think about that. If you've got parents with 2 kids in college and the kids are living with them and they're both working, those are 4 incomes you're counting, and all of a sudden your maximum income of $60,000 is blown over, right? But Home Advantage, we don't have to worry about those kids in that case. So there's just some flexibility in that program that's really cool. Now, having said that, that other program, House Key Opportunity, is the one most people are familiar with. That program has an income limit on it, but it has a much better rate than Home Advantage, and it offers a couple of other cool little features that just make it really attractive. So whenever we can fit someone into a House Key Opportunity with those income limits, that's the way we're going. But whenever we've got someone who they just have too much income, like, okay, let's go Home Advantage and let's get you going.
Yeah. And then, so is there a fee involved with that then?
There's not a fee specifically. There's a $200 fee with Washington State Housing Finance, but essentially you finance it with the whole process, so you're not really paying it out of pocket. And then you've got to do an escrow and title fee for the second mortgage. So I just stole the show there, right? So what we do is we've got a regular first mortgage, FHA conventional. We create a second mortgage, okay? The second mortgage covers that down payment. So the funds that you can get through either House Key or Home Advantage are going to cover either the 3% down conventional or the 3.5% down FHA. So the funds are going to be enough to cover those down payments. So now all we have to do is worry about the closing costs and getting those covered. So ideally the client has their own closing costs available. If not, then we're starting to work with the seller to kind of help with that. So you can get into a home with very little out of pocket and get started.
Right.
And the thing of it is, with all these programs, Carl, we're not just letting anyone buy. You've got to have decent credit. You've got to have a job. You've got to have income. You've got to meet debt ratios. This isn't the wild, wild west of the early 2000s.
Right.
So if you're worried that, holy cow, what are you doing letting someone buy with no money down? Well, we're getting them started on probably their best wealth building opportunity in their lifetime.
Yeah, absolutely.
We're helping them get started on that. And they're eventually going to get to a point, they can handle the payments. So they're going to get to a point where they're going to build equity and get into a little bit better program, and then they're just going to kind of keep going from there. So I just think people who worry so much about zero down in the current market we've got in lending, it's not as big a deal as it once was. They're in a 30-year fixed loan.
Yeah.
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 Their rate's not changing and their payment's not changing, so they control that.
Right. So, working with so many buyers over the years, what do you wish buyers knew?
Well, we've hit on one, that you don't need that much money down. That's a
huge one.
It's a huge one, because I think there's a lot of people that don't even start looking at the process because they think they just don't have enough money. That's one thing. The other thing I wish people knew more about was how important their credit history is in the process. And I think we're getting better at that in some respects. I think social media actually has been kind of helpful in terms of educating some people about, okay, be aware of this. But that's one of the big conversations I have with first-time home buyers. If they didn't already know it, okay, what steps do we need to take to help someone get into a little bit better spot? As we talked about kind of that difference between FHA and conventional, what was my overriding criteria? Credit score, right? So if we've got someone in a situation who's at a 620 credit score and we're trying to get them to 640 so they can use FHA, they can actually do it at 620. It's just very expensive. So 640 is what we really want to get them to. We can walk them through the process of how to get to 640, okay? So I like to have people start the process early. Even if they don't think they're going to buy for 6 months or a year, no, let's talk now. Let's start putting a plan together, because a lot of times we need to work on that credit,
Right.
and get that going. So one of the other really fun things that happens with credit, I'll have people come in and their scores won't be quite where we want them to be, but it's often a really simple fix, and that's simply because a lot of people will keep a balance on their credit card that's higher than the scoring model likes to see. Okay, so the general rule of thumb is if you can keep your balance to 30% or lower to your credit limit, you're going to be fine with credit scores. And if you only have one card that's higher than that 30%, not a real big deal. But if you have multiple cards that are above that 30%, that's going to hurt your scores.
Right.
So, but that's a really easy conversation to say, okay, these 3 cards, let's start working on paying down these balances. And sometimes it's $500, and someone will tell me, oh, give me 2 months. Give me 2 months and I'll have those paid down, and then so what we do is say, okay, great, you get those paid down. When you do, let's get those updated statements, and we're going to do what's called a rapid rescore. Okay, what that means is we take that information, we send it back through our credit company, through to the credit bureaus, and they update the information and do a rescore right then. It takes about 7 days. So instead of someone waiting 6 months for their things just to happen, 2 months and 7 days, we're in and ready to go. Okay, I've had people who have said, oh, I can pay that down now. And a day later, I've got an updated statement, and 7 days later, we have their score, and off they go. So it can happen really fast. So that's just one of those things. If we can start that conversation early, that's super, super helpful for people to get on the path we need to be on to get in that best program that's going to work for them.
So just in terms of credit, is there a golden number of credit cards to have?
Good question. Typically, I'd say less than more. What I can tell you is the best credit scores I've seen in my career tend to be from people who have a mortgage, maybe an auto loan, maybe not, and 2 credit cards. Now, they've had lots of other credit history over the years, but that's really all they're using right now. So the one thing that is important with a credit card is to use it, okay? So as an example, if I've met with a client and they have no credit whatsoever, they've just never established any, and so they have no credit scores, what I will tell them is try and get to a credit card through your bank, through Capital One, through whomever it might be, and if you can just get it set up without any other work, great. So get that set up and get going. If you get denied, go to your bank and say, hi, I'm going to put up $300 here. Will you give me a $300 credit card, a credit card with $300 limit? Because it doesn't need to be a $2,000 limit, a $3,000 limit. It just needs to be something that you use every single month. And so what we want them to do is get a $300 limit credit card, and then once a month, pay for a tank of gas, pay for some groceries. Let the bill come to you, and then pay off the balance. So you're not paying any interest on that. Right? The bill comes, you pay it off, you don't get charged interest. Right. It's only if you don't pay off the whole balance that interest starts charging. But what you've done there is you've run a whole cycle, and that's now getting reported to the credit bureaus. So now you're getting registered with credit. And it takes 5 to 6 months for that to really start registering where you get a score developing. But it's just as simple as that. So I know a number of times I've had conversations with clients where they're like, yeah, I'm going to do it, and I'm going to get a $1,000 credit card, and I'll leave the balance on it. No. You don't have to leave the balance on it. You just have to use it and pay it, use it and pay it, use it and pay it. And it doesn't have to be a big dollar amount. Because my idea there is I don't want them to get into trouble with the credit card, right? Because you've probably met people who have found these credit cards like, oh my gosh, I can buy all this stuff.
Right.
I don't have to pay for it right away. Look, yeah, but you do eventually.
Right.
And that interest starts accruing pretty brutally if you have too many cards out there.
And it's more beneficial to have like the longevity game of like keeping the credit card for a long period of time, right?
Yes.
Okay.
Yeah. And one thing that I'll hear some people say is, I'm going to cancel all these cards out. Well, you don't doesn't really help you a ton to cancel them out. Just don't use them. Just don't use them. But having that good paid as agreed credit history, that's worth a ton to people over the long haul.
Right.